Today, I'm breaking down 5 hot stocks that everyone's talking about: Oracle, Palantir, CoreWeave, Amazon, and Meta. These aren't just random picks, folks. We're living in the AI revolution right now, and all these companies are riding that wave in different ways. I'll give you both sides of the coin: the technical analysis, where we read the charts like tea leaves, and the fundamental analysis, where we dive into the money-making machine behind each company. Think of it as getting both the street-smart view and the book-smart view. Let's jump right in.
JOYUP Invest Forecast. Stay ahead, stay cool.
Starting with Oracle, that old-school database company that somehow became the cool kid on the AI block again. Funny how things work out, right? From a technical standpoint, Oracle just smashed through multi-year resistance levels like a hot knife through butter. We're seeing a classic transformation story here. They've successfully reinvented themselves as a cloud leader and are now cashing in on the AI boom big time. The RSI is sitting at 70.28, which technically puts us in overbought territory, but here's the thing: in strong trends like this, stocks can stay overbought longer than your patience can last. The volume is increasing, which tells us the big money, the institutions, are still accumulating shares. Short term, I'm looking at 350 to 360 as the next targets, with resistance around 345 and 355. If it breaks through those levels, we could see 370 to 380. On the downside, support sits around 320 to 325 and 310 to 315. Now for the fundamental picture, and this is where Oracle really shines. They've got a buy consensus from 27 analysts with an average target of $290.93. Now that's actually below the current price by about 12%, but here's the kicker: several firms are raising their targets. Global Equities Research just slapped a $400 price target on this baby. Oracle's strength comes from their cloud transformation and AI infrastructure play. Their RPO, that's remaining performance obligations, basically future contracted revenue, jumped 62% year over year to $130 billion. That came from $48 billion in new contracts just last quarter. Their cloud infrastructure consumption revenue grew 67% year over year, and total cloud growth is expected to hit 25 to 27%. Their revenue growth forecast sits at 16.38%, which beats the industry average of 14.25%. Management is confident they'll hit $66 billion in revenue for fiscal year 2026. That's 15% growth. And get this, their ROE forecast is 99.99%. That's not a typo, folks. I think Oracle is seriously underrated right now. Strong fundamentals, reasonable valuation for a growth story this solid.
Next up, Palantir, the company that's either the next Amazon or the next cautionary tale, depending on who you ask. This stock divides people like pineapple on pizza. Technically, Palantir just broke out from a long-term base pattern, and man, what a breakout it's been. They're riding the AI boom and data analytics wave perfectly. RSI at 67.19 is still reasonable, and the MACD is showing strong momentum. The volume profile is increasing, which means the smart money is getting involved. Short term, I'm watching for a test of $180 to $190 with resistance at $175 and $185. If it breaks above those levels, $200 plus is definitely in play. But if profit-taking kicks in, support levels are at $150 and $140. Now here's where it gets interesting. The fundamental picture is all over the map. We've got a hold consensus from 19 analysts with an average target of $137.16, which implies a 15.5% downside from current levels. But check this out. Wedbush has a $200 target, while Wolf Research has a $7.50 target. $7.50! That's like saying the same restaurant is either 5 stars or a health code violation. Palantir's strength is undeniable growth. They're forecasting 2025 revenue of $3.74 to $3.76 billion, which is 31% year-over-year growth. U.S. commercial revenue is expected to grow 54% to $1.079 billion. But here's the elephant in the room: valuation. The PE ratio is 536 compared to the software industry average of 42. Let me put that in perspective. You're paying 536 times earnings for this company when similar companies trade at 42 times earnings. That's like paying Ferrari prices for, well, maybe a Ferrari, but maybe a really expensive Honda. There are also concerns about their dependence on U.S. government budgets, especially with potential 8% defense spending cuts on the table. Palantir has an amazing growth story, but that valuation is stretched thinner than pizza dough at my cousin's restaurant. Now, CoreWeave, this is the company most people haven't heard of, but it's basically the picks and shovels play for the AI gold rush. Instead of trying to strike AI gold, they're selling the shovels, or in this case, the computing power. Technically, CoreWeave is showing a breakdown from a descending triangle pattern and can't seem to get back above $140, $145. The RSI is at 42.47, which puts us in oversold territory, and the MACD is showing negative signals. Volume is increasing on the downside, which suggests distribution. That's fancy talk for people are selling. Short term, I'm watching for a test of support at $110, $115. If that doesn't hold, we could see $100, $105. Any bounce would likely face resistance at $130, $135. From a fundamental perspective, CoreWeave is the ultimate high-risk, high-reward play. They've got a buy consensus from 17 analysts with an average target of $109.18, suggesting 16.71% upside. But the range is massive, from $32 to $200. Talk about disagreement. The growth story is incredible. Q2 revenue grew 207% year-over-year to $1.21 billion, and they raised 2025 guidance to $5.15 to $5.35 billion. That's 174% growth. Their revenue backlog expanded to $30.1 billion, up 86% year-over-year. But here's the catch. Profitability is a mess. Operating margins fell to 2% from 20% last year, mainly due to $145 million in stock-based compensation. They're sitting on $11.1 billion in debt and posted a net loss of $290.5 million, though that's better than the $323 million loss last year. CoreWeave is pure speculation. If you're conservative with your money, stay away. If you like roller coasters and have money you can afford to lose, this might be your ticket. Amazon, the everything store that somehow became the king of cloud computing. It's like watching your local grocery store turn into NASA. Technically, Amazon is sitting pretty in a rising channel pattern. RSI is at 59.20, getting close to overbought territory, but not there yet. MACD is showing positive signals, but here's what's got me a bit concerned. The volume is declining. That could mean the buying pressure is weakening. Short term, I'm looking for Amazon to test resistance at 240 to 245. If it breaks through with strong volume, we could see 260 to 270. If it doesn't, expect a pullback to 215 to 20. Fundamentally, Amazon is still the darling of Wall Street. Strong buy rating from 45 analysts with an average price target of 261.76, suggesting 9.87% upside. Cantor Fitzgerald has the highest target at 280, while Wedbush sits at 250. Amazon's got three main engines firing. AWS expanding CapEx by another $33 billion in 2025, e-commerce recovering from post-pandemic normalization, and their advertising business growing like crazy. Analysts think AWS will finally catch up to Microsoft Azure soon. EPS forecasts show $6.36 for 2025, growing to $7.36 in 2026 and $9.04 in 2027. But here are some warning signs. Their ROA forecast of 19.43% is below the industry average of 26.12%, and their earnings growth rate of 9.7% is slower than the market average of 15.43%. Amazon is still a solid investment, but keep an eye on that valuation. It's getting a bit stretched.
Last but not least, Meta, the company formerly known as Facebook that's trying to convince us the future is virtual reality while also becoming an AI powerhouse. It's like watching someone juggle flaming torches while riding a unicycle. Technically, Meta is near all-time highs in an ascending triangle pattern, but the declining volume has me worried. RSI at 62.46 is creeping into overbought territory, and we're seeing slight MACD divergence. The fact that it keeps testing resistance at $760 to $770 without breaking through suggests some serious profit taking. Short term, I give it a 60% chance of breaking through to $800 to $820 if we get good news as a catalyst. But if it doesn't break through in the next 2 to 3 weeks, expect a pullback to $720 to $730. Fundamentally, Meta gets a strong buy rating from 45 analysts with an average target of $816.16, suggesting 8.47% upside. Loop Capital raised their target to $980 from $888, using 30 times 2026 GAAP earnings plus cash. Meta's growth comes from AI empowerment, driving their family of apps ad revenue up 21% year over year, with online commerce being the main driver. Plus, Threads now has over 300 million users and is expected to generate $8 billion in revenue and $4 billion in operating income by 2027. But here's the reality check. DCF model shows an intrinsic value of only $514.38 compared to the current price of $747. That's 31% overvalued. Plus, CapEx is increasing to $64 to $72 billion in 2025, which will impact free cash flow. Meta has potential, but that valuation is getting pretty scary. All right, let's wrap this up with some real talk about what to do with your money. After looking at both the technical charts and fundamental numbers, Oracle and Amazon have the strongest fundamentals with sustainable competitive advantages and reasonable valuations considering their growth prospects. Meta has potential, but that valuation is high. Watch out for increasing CapEx. Palantir has an exciting growth story, but the valuation is stretched like a rubber band. CoreWeave is pure AI infrastructure play, but comes with massive execution risk. The market is showing more rotation and discrimination lately. Companies with strong fundamentals like Oracle and Palantir are holding up well, while high valuation plays with unclear execution like CoreWeave are facing pressure. For portfolio allocation, I'd suggest Oracle 30%, Amazon 30%, Meta 20%, Palantir 15%, and CoreWeave 5%. But you absolutely need proper stop losses and close monitoring of quarterly results. Focus on companies with clear competitive moats and sustainable advantages, especially with the Fed considering policy changes. Diversification between value and growth will help reduce risk. Watch volume and institutional flow closely. That's where the smart money shows its hand. And most importantly, have solid risk management. In high volatility periods like this, preserving capital is more important than chasing every move. In the AI market, execution and competitive position can change overnight. Investing with discipline and avoiding greed is the key to long-term success. That's a wrap on today's 5-stock breakdown. Hope this helps you make smarter investment decisions. Remember, investing always carries risk, so do your homework before making any moves. Thanks for tuning in to JOYUP Forecast. Catch you next time.